Well, thank you very much, John. I very much appreciate the intro, and thank you to everybody in attendance for allowing me to speak for a few minutes today about the group that I represent and ultimately what we see going on in the world today as it relates to money. My hope is that you come out of this meeting and you find some personal benefit and professional benefit as well to the topics that I'm going to cover. Before I get started, though, let me just provide a little bit more of a deeper background on myself and the group that I represent. As John said, for those who aren't familiar with us, AAF Wealth Management is a wholly owned subsidiary of AAFCPAs. We operate as an RIA, a registered investment advisor, providing an array of investment advice and advisory capacities to our clients based solely on a fiduciary model. What that really means is at the end of the day, we don't sell things for a living. We actually provide real advice to clients. I think when most people think about organizations like ours, they normally associate what we do for a living as being largely relegated to the individual investor. But in reality, we do an awful lot with the nonprofits that AAFCPAs works with. Our services, they span the full gamut, working from how to best manage organizational cash and endowment reserves to potentially, looking at employer-based retirement plans and even advising on benefits packages to help retain and recruit executive employees. In my role personally, I serve as one of the 5 advisors that work for AAF Wealth Management. I also oversee the investment committee that manages our investment portfolios. So going back a couple months, when I was asked to speak at this event, it kind of struck me really that there's 2 topics that I figured might be germane because they come up pretty much every day in our conversations with clients, and hopefully you might find them of interest as well. The first of those really is going to be the state of the economy. Where is it today? Where do we see it going? And then secondly, how does what we just experienced last month, i.e. the banking crisis, how does that affect you as fiduciaries overseeing your organization's assets? So let's go back to point number 1, which is the economy. There is no shortage whatsoever of opinions today in terms of where we are and where we're going. I'll make a case that the economy, if nothing else, is very stubbornly persistent. And while that opinion is going to be formulated from a large number of data points, there's primarily 4 that I think you could boil it down to help, really formulate that opinion. So the first metric I look at is unemployment. In general, I think when most financial forecasters, make a forecast, they rely at least in some part on that figure when it's released each month. When we look at the most recent reading, which was in March, the number came in at 3.5%. At 3.5%, it's pretty hard to argue we don't have a strong labor force at present. By way of comparison, over the last 75 years, the unemployment rate has tended a little bit closer to about 5.75%. So by and large, significantly lower than the long-term average. What a strong workforce is really going to translate into is reflected in spending patterns. Ever since we emerged from the COVID lockdowns 2 years ago, spending has been consistently strong. And that's been both strong at the retail and the non-store sales levels. These data points are at their highest levels since March of 2020. And that's even with the personal savings rates having been drawn down over 85% since that time frame. So you think about it, as strong as we are, and there's very little cash in the bank. The spending patterns in turn fuel metric number 3 for me, which is inflation. As we know, inflationary levels today are much higher than they've been in the last several decades. When you look back to, like, say, 2020 and 2021, the Federal Reserve really struggled to come up with any sort of scenario whereby they saw inflation making a meaningful comeback from what at the time were pretty big disinflationary lows, kind of economic shutdown that we had. As such, the Fed kept interest rates at around 0% for most of 2020 and 2021 as it tried to re-engineer a comeback. You fast forward to 2022, right? And we all know what happened. Inflation absolutely surged to levels we hadn't seen since 1981. The CPI, or Consumer Price Index as it's known, reached a high water mark of about 9.1% last June. So again, by contrast, if you look back over that 40-year period, going back to the early 80s, CPI's averaged about 2.5%. So in response to this massive surge that we saw, the Fed basically raised rates last year 7 times. They brought interest rates from 0% in January all the way up to about 4.5% at year end, with the hopes of curtailing excessive spending. Did it work? For the most part, I'd say yes, right? The Fed's actions have definitely had some impact on bringing prices down at large. But the Fed can't take all the credit. When you think back to last year, oil in large part was a big piece of the inflationary surge. the Fed has very little oversight in terms of that metric and how that kind of plays into the larger economic sort of situation. Given what the Fed would describe as their long and variable lags, i.e. it takes them a long time to see the results of when they make a change, we've finally started to see some actual real noticeable difference here in the first few months of this year. As of March, a couple months ago, or last month, the CPI report came in around 5%. Far cry better than 9% just 9 months ago. So when you kind of take these metrics together, when you look at strength in spending, strength in the workforce, the inflation factor, what it's all kind of leading to at the end of the day is, where do we fall out from a GDP perspective, or gross domestic product? In essence, GDP is really just a measuring stick for whether the economic output is growing or shrinking. By definition, a recession is going to be 2 consecutive quarters of negative GDP growth. As of today, there's an expectation that the first quarter GDP is going to show a positive number when it's actually released tomorrow morning. And if that's correct, it means that we can't, technically speaking, start the countdown to a recession until at least the second quarter's numbers released over the summer. So all that said, right, the data release, irrespective of what it says, isn't going to stop the debate of whether or not a recession is coming, which is pretty much everybody's minds these days. Ultimately, the Federal Reserve's interest rate policy is going to have a lot to say about the eventual outcome of just how long we continue to expand, or if the economy starts to shrink. As an organization, the Federal Reserve basically has a dual mandate. Firstly, they need to keep a healthy level of employment in the overall economy, but then secondly, they also need to keep inflation under control. As already noted, the data show the employment situation is at historically good levels. At the same time, inflation, we're at levels we haven't seen in decades. And while that trend that I discussed before from 9% to 5% has been obviously down in the last 9 months, the Fed is not looking at that as favorably as you'd expect. Their goal is to get that number down to a 2% rate. So the method by which they can bring down the CPI to that level is through continued interest rate hikes. And so what we're going to see is next week, the Fed is going to meet on May the 2nd and release their notes for their next interest rate decision. It's largely expected the Fed will raise rates for the third time this year by another 0.25%, bringing what's called the federal funds rate, which is the overnight or short-term rate that sets the overall rates for the system, to 5.25%. The question really, I guess, is, why should this matter to you, right? There are 2 very big outcomes that can result from the Fed's policy. First, when the Fed continues to raise rates, if it continues to raise rates, we will get to a point where they eventually break the economy, right? At some point, we will then trend into what has been forecasted as probably the most forecasted recession in history, is sort of the ongoing joke. And while one can debate whether that's going to be a full-blown recession if we hit it, or whether that's going to be more of a soft landing, the fact remains, if you go into a recession, things will cool down and unemployment's going to rise. Secondly, still in most people's minds, though, fresh off of what we just saw in March, is what happened to the banking system. We won't get into all the gory details, but suffice to say, by virtue of banking regulations that were enacted about 15 years ago after the Great Financial Crisis, banks are largely required to hold excess deposits in government bonds. Over the past several years, though, going back to COVID, there was a massive influx of stimulus checks from all the various pandemic response policy programs, and banks saw an enormous increase in their bank deposits. In an effort to stay within regulations, but at the same time, obviously make money, they're banks that want to make money along the way, banks took those dollars, they purchased long-dated treasury and government mortgage-backed securities, hoping to put that money to work and to earn some yield. Unfortunately, when you look back to 2020 and 2021, long-dated interest rate products weren't offering a whole heck of a lot of yield. And as a result, when interest rates rose quickly like they did in 2022, the effect on those bonds prices got very ugly very fast. The basic relationship between bonds and interest rates is sort of an inverse relationship. So when bond prices rise, interest rates drop and vice versa. With the rapidity with which we saw rates rise last year, bond prices came under significant distress and caused significant damage to bank balance sheets. So what we saw last month actually was 2 of the 3 biggest banking failures in the history of the US just occurred. The only one that was larger that happened was during the Great Financial Crisis in '08. And while these banking failures were to some degree, I guess, set in motion by very unique business models, the banks that that failed dabbled in crypto and venture cap and had very unique models relative to the vast majority of banks. All banks in the U.S. to some degree showed a common trait that came out of that mess. And that very interesting data point that we learned last month, was exactly how underinsured most bank deposits are in the U.S. these days, relative to FDIC limits, that is. So go back to some of the things we learned last month. Silicon Valley Bank, the biggest name on the list, 97% of the deposits in that bank were underinsured. More than half of the top 10 regional banks in America, their deposits are underinsured. I should say more than half of the deposits at the top 10 banks are underinsured. Even if you look at what they call the too big to fail banks, JP Morgan, Bank of America, Wells Fargo, Citigroup, they're sitting on very large uninsured deposits. We're talking about, nobody can really calculate at this point, we're talking about possibly trillions of dollars of uninsured deposit exposure. So while the Treasury, the FDIC, Congress, the whole bunch of different government institutions rode to the rescue of Silicon Valley depositors last month, I definitely wouldn't count on it happening again necessarily. Janet Yellen, she's the Secretary of the Treasury, she stood in front of Congress during that second week of March after SVB failed. And under oath, she explained that it wasn't feasible for the government to actually provide blanket FDIC insurance like they kind of intimated toward when SVB was going up in smoke. And so we're talking about here is about $17.5 trillion of potential banking deposits in the United States. Take it for all it's worth. I can tell you that my team, we speak about the $250,000 FDIC/NCUA limits pretty much in every discussion we have with clients these days. It's topic du jour number one. It's very important, and yet it's incredibly overlooked for whatever reason. So it kind of brings me to the point of my group and how we can potentially help you, the actual legal fiduciaries charged with overseeing the nonprofit assets that you have. We've seen a very significant uptick in nonprofit interest in discussing these matters, with us. We work with clients individually to build out cash management systems, to assess those risks, to tie cash flow needs to the timings that are required. We do it within the context of adhering to either FDIC limits and or utilizing different government-related treasury securities like treasuries and things of that nature. So at the end of the day, if you're currently in a position where your cash deposits exceed the $250,000 threshold at the banks and credit unions you work with, I would strongly suggest you have a conversation around those risks that you may or may not be exposed to. So with all that said, John Buckley, who kicked off this the conversation today, he penned a great write-up last month, and it spoke to a step-by-step process that we suggest that nonprofits use to both assess and correct any deficiencies that they may have in these areas. We're fortunate to have John here in the virtual attendance today, so I'll ask him to come back on stage for a minute and just talk a little bit more about some of those ideas that he spoke to. That said, should you wish, after this event, to speak with any of us in the wealth management division, please speak to your AAFCPA contact. We'd be happy to be arranging a discussion with you. I thank you for your time and wish you well.
Great. Thank you, Kevin. You're right. I wrote an article last month. When SVB failed, we had a lot of clients that had funds with SVB. I think one of the biggest takeaways from there is, organizations need to look at their cash management policy, right? I mean, that's really critical. Where do you feel your risk should be? And you need to weigh your risk versus the reward. Obviously, as you said, we have a lot of organizations that have way over the FDIC and insured limit. So you need to look at what's the best way to mitigate that risk. Is it the FDIC limit? Is it the other types of insurance? Like in Massachusetts, we have Depositors Insurance Fund. Is it treasuries if you have excess cash? Does the bank offer any other type of sweep accounts, things like that? So, it's really kind of looking at a cash management policy, making sure that you're documenting your policy and that it kind of really looks at your risk and making sure that your risk is mitigated and that you're comfortable with the risk. But take a look at that blog. It's on our website, and we'd be happy to talk to anybody. As Kevin mentioned, there's a lot of different strategies to do.